Hi everybody, this is Gary Dean and this is our weekend video report for Monday, July 4th, 2016. I hope you guys are having a fantastic long weekend, and let's get started. So on really Thursday and Friday, I just said it really wasn't worth making any big bets. It was low volume that was going to go on. They were most likely going to try to grind things higher. They did. It was nothing crazy, and I would take this entire move with a grain of salt, and I'll explain why. So Thursday, we had the SPY was number one as far as selling rallies, the big boys, and we also had it again on Friday. So this is we saw money flow total is minus 448. It was in the number one spot. If we go and look at block volume, minus 508. So there was a lot of selling going on, and there was selling going on Thursday. So again, when you see the big boys doing this stuff, you don't really want to fall in love with the side that the majority are on, which is believing that the market's made the low and we're going to continue higher. The reason why I am still pretty negative on this market is these bearish divergences here have not played out. This two-day drop right here did not do anything as far as with the retracement that should have been done from these divergences. Now we have more divergences that are pending right here, because you can see that we made a higher high. So this is another divergence, and we've yet to have a kind of complete recycle of momentum going all the way back to really, let's just say, February. So this is a long time to be really just trying to hold things up. I mentioned that at tops, things get very choppy. They got very choppy here. They're getting very choppy here. And what I'm anticipating is what is pending is going to be something like this. But the thing is that I don't believe we're in this phase here. We are still in this chop zone. So my guess is that we're going to start closing some of the gaps. And then once they're closed and we chop back and forth, eventually it's going to come to this move right here. But the bearish divergences and really the lack of recycling of memento has me really pretty extremely bearish on this market. 60-minute chart, I had said we didn't really have any bearish divergences in place, so I didn't really have a reason to get overly aggressive heading into a long weekend. We do have some trying to form right now. On the MACD, we already have them. You can see that it's trying to cross right here, and momentum is extremely overbought. And this was the trend line I drew on Thursday, and you can see we went right up to that level right there, and that was it. So what I believe is going to happen, and how this will play out as far as with the choppy section that I'm anticipating, is you're going to see the bulls try to form an inverted head and shoulders pattern, where this is going to be the left shoulder. Here is the head, and what happens is we're probably going to have another drop someplace down into the 2040, 2030 area, or just say come down and close this gap here down at 2034. That makes the right shoulder, and then what happens is they're probably going to rally it back up again. And the bulls are going to look at this saying this is it's a bullish pattern, and we're going to break out to the upside, and that's when I believe everybody is going to be piling in on the long side, and it's going to be right before we see a drastic move to the downside, because typically the majority is wrong all of the time, and they're going to be trading this pattern, and it's a setup pattern. And the reason why is this is taking place at the top of a chart. An inverted head and shoulders pattern is a bottoming pattern. So when it happens at the top of the chart up here, it's a trap. And what happens is they'll form it, and they could even get a slight breakout. But the thing is this, the way it traps people is, if this was a true inverted head and shoulders, let's say at the right side of the chart, we are looking at an additional let's just say 1990 up to 2122. So it would be an additional 140 points above these levels here. That brings you well into the into the 2200 range, and it's not happening. This is I don't believe that this because of the bearish divergences that are in place, and two, this is happening at the wrong side of the chart. If it was happening down here, I'd pay a little more attention to it. This is the top of the chart is where head and shoulders form in their bearish patterns, bottoms or where inverted head and shoulders patterns form, and they're bullish. So when they happen, either if there's a head and shoulder that happens at the lows, don't buy it. Don't believe that it's going to play out to the downside. And if there's an inverted head and shoulders at the top, don't believe that it's going to break out. Most likely it's going to be a trap. And from there, everyone's going to be jumping over each other to try to get out of their positions. So I can see that happening over the next couple weeks, where we get, it could chop around. We may even go a little bit higher. There is no, we don't know if this is the exact top right now. But once this has this pullback, this is where I expect them to hold, and then from there try to rally. And this is going to be the suckers rally, where you probably want to get really, really aggressive on the short side for the big move that's going to take these lows out and take out a lot of lows, and people aren't really going to be anticipating that. So I had mentioned a few times that the bears are really, really clean creatures. They don't like to leave any gaps, and they closed this one. So it took them not a whole lot of time to close it, but they came and they closed the gap from the Brexit thing. And now we have two gaps that are below that are waiting there. And that's really been the way that the bulls have been doing it. It's been on gap hires. And the thing is that it means that the move is built on really the foundation is made on quicksand, and this is not going to be something that's going to break out and it's going to be a new rally to all-time highs. I believe that this is a suckers rally. I don't even think it really squeezed that many shorts, because I don't know how many shorts really were short in this 2-day drop, because it happened so fast. So to me, I think the smart people that are shorting this market started shorting it all the way up in this area. So it means that all the energy and all the money that was spent to push it up here is now going to be trapped at higher levels. And again, that's when they start jumping over each other to get out of the market. So we have the bearish divergences that have formed in on a 15-minute chart, very, very overbought. Again, a 62% retracement closes this gap. 2036 would really be my bare minimum area that I would anticipate this the move to go. But there's also support between 2055 and 2050. So right now, I'm not really too concerned on how things open tomorrow or what's going to happen. I would just say do not buy into this rally, and I think it's just really setting up for a much, much better shorting opportunity that we can possibly start to get aggressive fairly soon. So with that, enjoy the rest of your 4th of July weekend, and I will talk to you guys on Tuesday.